Good morning, good afternoon, wherever you're at. Grizzle's
We're back.
We're live. Scott, we got a special one today. We got the king of short interest, man. Understanding the short dynamic market. Scott, give the intro.
All right, this is Ihor Dusaniwsky. He's the man. He's the man you go to. Anything related to short selling, that type of data, it's not easy to find, and it's not easy to find it done right. So he's the man, and we're going to talk to him all about that type of thing.
Yeah, guys. You know what? This was, Ihor, welcome.
First of all, yeah, welcome to Grizzle.
Yeah. Thank you. Great to be here.
Thank you. So Ihor is totally like, when I remember finding you back, when I first joined Twitter, you had some of the best data about all the short interest in Tesla and how the shorts were losing so much money. It was always wild to see that. It was crazy.
Big numbers.
Big numbers. What do you know? What you always seem to have all the numbers. Maybe you give a little bit of history on S3 Partners and how you guys came about and how your data is different than just if I go on my Bloomberg and I see short interest, whatnot, right?
Sure. I mean, we're a technology and data company. We started out 17 years ago as basically an outsourced securities lending, securities finance desk for hedge funds. And we also were an aggregator of data. So basically, when a hedge fund has all these prime brokers and swap counterparties and all these reports, I mean, they're just inundated with paper. It's kind of like when you have a credit card account, mortgage, savings account. I mean, you're going into six or seven different sites, putting in your codes, putting in your passwords, and getting all this data, and you have to scroll through, tens of pages till you get your numbers. Well, these guys, it's times 100. So we basically got pipes into all the prime brokers and were able to get all the data, consolidate it, normalize it, get it all in one place so they can see, hey, I'm long IBM in 6 prime brokers. Here's my net position. I am short, GameStop in all these prime brokers, and this is what I'm getting charged. This is what my financing rates are. So you really get a full view of everything out there. That's part of what we do is we make data easy to consume. Really, it's information till it comes in and it becomes data, because data is what you can actually work on. We produce analytics for our clients. We make this distributed platform easy for guys to work on their desktops worldwide. We deal with worldwide stocks, so it's not just US based. We deal with Europe, Asia, emerging markets as well, follow over 50,000 securities. And what we realized was we had this huge infrastructure that was sitting there and we were using with our clients, but we said we can kind of package this up, and we created something called the Black App, which we sell on Bloomberg, Refinitiv. We have data that goes through Snowflake and AWS. So we have it, and we're now having a web-based platform, so guys that aren't on these big sites can actually get it as well. So it's going to be a little easier for even the retail or smaller institutions to consume and use on a daily basis. So instead of having to wait, 3 weeks for stale data from the exchanges, we calculate using our algorithms. We calculate short interest, financing rates, and activity on a daily basis. So you get to see what's going on live time. And with my background in stock loan for 30 years, and I started out controllers and back office at Morgan Stanley forever ago. So I've got a background of like nuts and bolts of how the market works. And now I've got the front end side from my stock loan days and working with Delta Swaps. So we kind of put all that together with all these other guys in our firm that have prime brokerage, trading, and back office and tech experience to create a product that really, really helps the investor, both retail, institutional, buy side, sell side, get real-time data at their fingertips and kind of look at their portfolio or look at names that are looking to generate alpha. Because short side is important for both the longs and the shorts.
For sure.
When you're looking to calculate what your projected alpha is.
So is your short data, first of all, it's real time, when if you go to the exchanges, it's going to be delayed like a month. But would you say that it's more accurate in some cases? Because I know from your tweets in the past, it's been, well, this data you're getting, it's not particularly right. This is how we do it. Is that kind of difference between you guys?
Yeah, there's a big difference between some other data that's on the street is stock loan data does not equal short data, because when you're looking at stock borrows, people say, oh, that's a proxy for short interest. Well, not so much. What you've got is stock loan data, which can be used for financing. So if I'm long a ton of IBM, I can actually lend it to someone to get cash in order to finance my book. So I'm actually, instead of going on into the CP market or short-term credit market and trying to borrow cash, I'm using my collateral as my way to borrow cash from my firm. And also brokers, this is an interbroker market. It's not like dealing with stocks and bonds which trade through an exchange. You're dealing with a broker to broker to broker. So you might have one stock loan going from the lender, which is a asset manager, a custodial bank, or so on, going to one broker, to another broker, to another broker, until it finally lands in a broker that has a short sale that's using it to settle the short. So I've got 4 transactions, but one short sale. So it doesn't.
So is that how some people could take all 4 of those and add them up potentially and say short interest is 150% or something like that?
And you'll see that a lot of times, that they're saying that there's all this extra activity that doesn't really exist. And now there's even a secondary thing where brokers don't necessarily go out and borrow stock to cover their shorts. Because if I'm a prime broker or a regular broker, a E-Trade, a Schwab, a Robinhood, a Morgan Stanley, Goldman Sachs, whoever it is, I've got a box. So I've got clients that are long stock. Mm-hmm. Now they are leveraged, so they're using margin, or they're, as a hedge fund, they're long and short, so they're using our leveraging capabilities to put on their positions. So as a prime broker or broker, I can actually take that long, well, I have to take that long as collateral because I'm lending them cash. So I'm not lending someone cash without giving us collateral. Well, as a broker, I'm not an idiot. I'm not picking IBM. I'm picking hot stocks that I need. So I'm picking the most advantaged stocks as I can for my collateral. Then I'm using that free collateral to cover my short sales. So I'm not even going out to the street to borrow stock.
Right.
You use the stock you already have
to borrow stock. So I got a zero cost, but I'm charging my client borrow fees. So it's 100% markup on every stock I borrow internally or free that I lend to the street.
Wow. That makes me realize cannabis stocks were a lucrative business, because I remember the borrows in those were 100% for a while.
Yeah, and then you've got a ton of stocks. You got your Tilrays, you got your even the smaller guys, Organigram. I mean, that they're might not have a ton of short selling interest. You might not be 400 million shares shorted, but it's a nice amount of money that that theoretically you can borrow for free, borrow cheap, and lend out to your short sales at a nice markup.
So is this an incentive for, say, the brokers to potentially lend to people who have these shares so they can get them because they're making some interest on the loan? Then they can do this and make that borrow fee too. So that's lucrative to them, that business model?
Yeah, you just kind of explain what prime brokerage is. I mean, it's really, I'm lending my users, my hedge funds, my institutions, cash in order to go long and short. So I have $100 million of AUM, and I'm going to go long 300 million, short 100 million. That is leverage. And basically, I'm charging my clients for the cash that they're using in order to put on this leverage. As an added kicker, if the guy's got some really, really good longs on his books, I get to use that and lend it out to either the street or to my other shorts in the book. So I don't even have to have a short on my book. I can actually lend it to another broker on the street that's looking for that stock.
So they can offset their risk of the leverage a bit by doing that stock loaning.
Well, you're offsetting the leverage 100%. Prime brokerage is a virtually, done right. It's a virtually a zero risk business because you're constantly marking to market your exposure on a daily basis. So I have enough collateral inside. So if there's any issues with the hedge fund or the borrower of my cash, I have enough assets in order to sell off and satisfy my loan. So when it's done right, it's a zero risk. It's basically a zero risk game. You have counterparty risk. There's always some sort of risk, but you do it right, and it should be, it's a home run for brokers.
Tom, I wonder what we have, Ihor, if we should talk about that hedge fund that blew up, because that's kind of like, is that going into, if you do it right, there's no losses. If it doesn't go right, it's like that situation.
Yeah, that's an interesting kind of segue because you've got a difference between what a prime broker does and what the swap business does. Two different pieces of a brokerage. So a prime broker lends cash, takes collateral, and should be fully collateralized and should be safe. Swap business is a different part of investment banks or a bank's business. They have totally different rules for margin, daily mark-to-markets, and it gets a lot more complicated, and there's a lot more things that go into it. So when people kind of get those two things together, it's not really the right way to look at it. It's two different business models, two different parts of the business.
So would you say the swap side of the business is not risk-free? They are taking on some actual risk on the positions?
The swap business has, it should be managed by compliance risk that minimizes any risk, but you always have counterparty risk, because a swap in essence is you're lending cash or you're lending exposure, not really cash, you're lending exposure to a counterparty, and you're keeping enough collateral in order to make yourself safe so that you're anticipating any big moves in the stock. You've got enough collateral to cover those moves. It's how many sigmas away do you really measure your risk is a whole different story. But when you have these black swan events where the markets move crazily, it's difficult to have to manage that kind of risk.
So Ihor, just on the GameStop, because obviously that was front and center for everyone, and that was clearly something, and obviously you were seeing a lot of for the facts you explained to earlier, that this idea that GameStop was shorted above 100%, and this was, everyone was like, this is not right, and I think you've explained some aspects of that, but I'd love to get your take on how that unfolded, and just S3's perspective, because you guys had a unique vantage point that I don't think everyone, everyone would have been privy to see that, how S3 would have seen it.
Yeah, let me actually start off by saying that nothing can be shorted over 100% of its flow. All right, because it just doesn't make sense. So what we kind of been looking at is the traditional short interest percentage of flow calculation, and I'm sitting there like, we're kind of looking at it, it doesn't make sense. It's logically, kind of mathematically, doesn't make sense. So what we came up with was the fact that, wait a minute, every short sale creates a synthetic long that no one's really kind of thought about, because you've got the lender, the original owner that owns the stock, that's lending a stock to the broker, who's giving it to the short seller to settle their trade, right? So you've got a buyer of that short sale. So you still have the lender long, and you've got the new buyer long. So really, you've got two longs and one short.
Right.
So in fact, the float is not the float. The tradable float is really the float number plus the synthetic longs created by every single short sale.
That's mind-blowing.
Wow.
It really is such a wild way to think about it. I don't think I've had it explained to me in that terms, but that really is a logical flow there. But you just think short minus, okay, it's not, and we're not heavily in the short business, so you're not thinking about it in those terms, but it's very helpful to see it that way.
Yeah, and so we came out with this calculation. We went through and did some historical look back at the numbers, and we said, okay, GameStop 140% short interest percentage of float, crazy number. Really, the S3 short interest percentage of float was 60%. 60% of the float. That doesn't mean that it's not a big amount of the float. 60% is huge. I mean, right now, high short interest percentage of floats is like 40%. It's you don't have these big amounts that like GameStop at the time. So what we saw, and kind of what our founder Bob Sloan was on one of the telecasts and was saying, hey, we're seeing that there's a short squeeze going on, and the price is going to go up because the shorts are getting out, and the longs are buying, especially the retail longs are buying that crap out of this name. So we're seeing that there's going to be a rally. So a week before the huge price spike in GameStop, we saw shorts going from 70 million shares shorted down to the 20s, 30s, and $20 million shorted. So there was a big drop in shares shorted. So to us, and if you had our system, you kind of saw, holy crap, the shorts are exiting this trade. Why? They're getting squeezed.
Wow, and that is like that is S3 in a nutshell, right?
Yeah.
It's like so as someone who's looking to go long, and I want some of this extra kicker of shorts exiting the trade. I think exactly. I'd be looking for S3 data. Tell me better real time perspective of when these guys are getting squeezed.
Yeah, so we saw the price going from the 20s up to 30, $40, and the shorts started saying, "Wow, I'm out." Why? Because they're down over $1 billion, $2 billion a day those couple of days. So the shorts felt the pain, got squeezed out, and as the price started going up to 30, 40, $50 a share, we saw more short covering, and also we saw a plateau. And I was like, all right, now what's going on? Why isn't the short covering continuing? Because the stock price is now going up over 100, 200, $300 a share. But I'm seeing the short interest kind of staying about the same, the shares shorted. What happened was we had a swap of short sellers. So the guys that were in earlier that felt the pain, that got the bloody nose from the P&L, were down $6 billion, $6 billion in P&L, were exiting. But you had these short sellers on the sideline saying, wait a minute, this stock went from $20 to 300. A little bit quick.
A little bit quick. I like that.
A little bit fast.
I got to believe there's a good chance that this thing's going to retrace a little bit or a lot. Mm-hmm. So I was talking to some brokers on the street, and this is kind of what I was thinking. I talked to brokers on the street because stock loan is and short selling is kind of a person-to-person market. And they said, yeah, as any share I get back from a short covering, I'm lending out to a new short seller. So you had value fundamental short sellers exiting the trade, momentum short sellers getting into the trade.
Okay.
So for a while there, you didn't have any change in total shares shorted because every share that came out, every stock borrow that came available was snapped up by a momentum short seller looking to ride the price down for 300 back down to whatever floor they.
So it was an equilibrium of shares sold short.
Exactly. For right around the time that it hit the $200 to $400 price, 2 to 3 something, whatever it was, price level to right afterwards, you had momentum shorts coming in and saying, you know what, on a technical basis, this was too fast, too large. It's got to be some sort of retracement. Eventually, the retail guys are going to run out of steam, and there's going to be some sort of. They weren't saying that it's going to zero. They were just saying that this doesn't make sense. This kind of big move this fast. There's got to be some kind of pullback, and they made money. So you had a bunch of shorts that got crushed and a bunch of shorts that made money.
Did you see anything interesting once it hit that peak and then came off, and there were a few days where it went below 100, back above that now? Do you remember, were you looking at it and seeing if any interesting things happened on the short interest? Did it go back up once it fell down to 100 or?
Yeah, one thing that happened was that the short borrow costs spiked. So at one point, new borrows were going at 200% fee. So you had to be right, and you had to be right really quick, because that short interest financing cost was eating up your profits. So I've talked to traders who said that, I'm making money. I made 20% of this trade. You go, yeah, but your borrow costs are 30, so you're losing cash. So you had to really manage your book, because if you were eating all these financing costs and you weren't in at the right time, you could be up, 10% in stock in price moves, but down 30% in financing. So what we saw was a lot of the momentum guys getting out after they made a quick killing because the financing costs were so high. So we saw kind of moving in and out on both ends, and eventually things kind of evened out where the old short sellers who lost a lot of money were basically saying, you know what, I've gotten pummeled. I couldn't even get out of the trade. Look at trade volume and stuff. These guys aren't idiots. They're looking and saying, how can I exit my trade? Well, I got such a big position. I'm just going to move the market more against me if I buy the cover. So I'm going to force another wave of buying. Let me hold off and let me try to see if it rides down. And I've already taken, X $1 million of losses. It sucks, but let me see if I can make some of that back over the next term. So we do have some of those short sellers still in looking to see that GameStop goes down to $15 a share. They're keeping their
they're waiting. They're hoping.
I was gonna say this sounds like F1 short selling, but it's more akin to like, what do you call it, crash car short selling. This is insanity, right? This is like truly bumper cars, go as fast as you can to get out of the car before it blows up, kind of thing, right?
Yeah, I mean, you hit the nail on the head. I mean, management on the short side is really important. It's I love to see people getting into the short side because it is a really, really important part of a portfolio for a lot of people if you know what you're doing. You can be long and you can lose a couple of bucks because stock goes against you, a bit, but you're not getting crushed. If you're short, you can get just wiped out and say, "Oh, I invested $100,000. That's a big bet. Oh, great, I'm down 600,000."
Yeah. You wake up to that, it's not a good day.
There's convexity in short selling that people don't understand, where the upside can be not quite as bad as the downside. So you got negative convexity in the trading, and really, really important for people to understand that you can lose much more than you can invest, and you have to look at it every day. And that's why our systems work for a lot of our clients, is because it allows them to see all their positions, all their rates. I mean, if my rate goes from GC, which is 30 basis points, which is nothing, to 4, 5, 6%, I got to look at it and say, you know what, is this trade worth it for me? If I have a 15% return target and I'm paying away 6%, you know what, maybe there's another trade that can get me a better return net of financing.
So Ihor, I gotta ask you, because you're probably one of the few guys that has one of the greatest perspectives on the Tesla short sellers. Have they all thrown in the towel here? Or where do we stand? Obviously, there was that huge aspect of Tesla short sellers, and they kind of just exited the trade. Have we seen any life in these guys coming back, nibbling away? Is there anyone around?
Yeah, it's a really interesting question, because we've seen basically a year and a half short squeeze on Tesla stock. I mean, the shorts have been getting out and out and out. Now, one of the things is there's a lot of convertible bonds on Tesla.
Okay.
So there are hedges to that convertible bond. So basically, half of the short sales in Tesla are hedges to the convertible bond. People go long to convert, short the stock, and basically you're hedging out the stock risk, and you're left with a bond, a normal bond, because you hedged out Tesla, you hedged out Elon Musk, and now you have a bond. So basically, because all the bonds are so far in the money, the hedge is virtually 100%. So if the conversion of a bond is 100 shares, you're short 100 shares against that because you're so far in the money. The bond is going to end up, you're converting 100% of the bond to shares. So that's half the shorts. Now, Tesla short interest is 24, 26 billion, depends on what time it is. So if it's only half, that means that you got 12 to 13 to 15 billion of hedges for converts, and that means you've got 12 to 15 billion dollars of short sellers, which still makes it the second largest short ahead of Apple at 12 billion.
Wow.
So it's still the biggest short, even if I take out all the convertible hedges. It's still the biggest short in the market. So shorts are still shorting the hell out of Tesla.
Wow. So I have a practical question that you may have just answered, but I'm sure everyone watching has wondered this as well. When you sell a stock short, you borrowed it, the rate can change, right? You haven't locked in that rate for those shares. The person you're borrowing it from, they can change the rate when they want to, your broker.
Yeah, there is such a thing as a term rate, which I don't normally, kind of tell people to do, because you're paying a big premium for that to lock in. Let's say I'm borrowing a rate, 1% for 1 month. And bottom line is that rate at 1 month can go up to whatever. But you get quoted a rate when you do a locate, or you should get quoted a rate when you do a locate.
That's happened to me.
Yeah. So someone says, hey, it's a 1%. So that 1% is for 1 day. So stock loan is a daily mark-to-market of collateral and daily mark-to-market of rates. So your broker can change that rate every single day.
Yeah.
So if you don't watch it, you can go from a 1 to a 5 to a 10 to, in GameStop, 200.
I hope everyone's hearing that. You got to watch your shorts, because the rates change every day. You don't lock in that rate.
Absolutely.
Good to know.
There's no vintage. You weren't part of an old.
And here's something that people really don't understand, is that it's not like it's a mark-to-market. The rates aren't mark-to-market to the market, because existing rates go up slowly So we have something called, we have a spot rate, offer, we have a bid rate, an offer rate, and a last rate on our system. Bid rate is what we think that a lender, if you're long, this is what you should be getting paid to lend these shares. So this is great for guys that are long stock and they go, oh, wow, I got a stock that's worth 4%. I got to talk to my broker and have him try to lend it out because I can make 4% extra return. Then you have an offer rate. So that's the spread that the broker is taking between what he's borrowing at and what he's lending at. So he might be lending at 5.5. So that's kind of what a fair rate is. Depending on who you are, if you're a big player or a small player, you can get better or worse than that rate. So because there's no, there's no rate that everyone takes. And then you have the last rate, which is what the last piece of business on the street has been done at. So the last rate could be 15. But stock loan rates on existing positions go up and down really, really slow. So because basically the lenders go to the people that are the borrowers are going to the lender. So the lender will say, you know what, I got to rate change this from a 5 to a 10. The borrower goes, no freaking way. I've been borrowing this stock for 3 months. You're not doubling my rates. You know what? I'll take it a 5.5 today. Tomorrow you can move me to a 6. So they're always looking to, the borrowers are looking to keep the price low, and the lenders are looking to keep the price high. And there's always this kind of battle between rates. So existing rates on existing borrowers always lag the spot rate up and down.
Interesting. Yeah. So it sounds like you guys have pioneered a bid-ask spread for this type of thing, which is still somewhat done in negotiations. It's not totally like a liquid public market.
Exactly. There's nowhere we can go and look at a bid offer screen and see what the ladder is on the bids and the offers and say, oh yeah, I should be getting around the 5.5. I should be getting around a 6. It's like, no. And you know what? If the prime broker gets a crappy borrow, one guy could be charging you a 10, another guy can be charging you a 3. Yeah. All depends on when he got it, who he got it from, and how hard he's worked the order. So that's why it's important to have multiple brokers. If you're a short player, you have multiple prime brokers or multiple brokers, because literally you can have several hundred basis points difference between prime brokers and between brokers on stock borrow rates.
Wow.
This is fantastic stuff. And everyone, guys, thank you so much, Ihor, for coming through. And we'd love to have you come back, explain more dynamics of the market. Guys, this is Ihor from S3 Partners. Clearly, the GameStop was a fantastic example of how this data can provide great insight for some big bangers for longs, and obviously great insights for shorts as well.
I got one more. I got one more before you leave it, Ihor, if you could indulge me. Sure. People look at the borrow rates, and they see sometimes if a borrow rate's really high, you'll see an article's written about it or something. Is there information that retail investors can take away from borrow rates? Like, what does it tell you if a borrow rate's 100% versus 5? Is there any useful takeaways when you see these numbers floating around?
Huge. Fantastic question. Huge information. People look at utilization rates. So how much is a borrow being utilized and stuff. That utilization rate is kind of crappy because the data that's being used to calculate that is all voluntary. So I can change my number as much as I want. Borrow rates is supply demand driven. That is really supply of borrow versus demand on the street to short. So when I see a high, over 90% of stocks are GC. So basically easy to borrow, 30 basis points, doesn't really make a difference. Yeah. The stocks that you're really interested in are the ones that are hot and trading big, have higher than GC rates, 1, 2, 3, 4, 5, 10%. So the higher the rate, the more of a stock is being actually borrowed, the more illiquid the stock borrow is, the less chance there is a lot more short selling in the name. So what you're looking at is saying, how much more short selling can I expect in this name at a rate of 10%? Not much. So basically short side's basically shot its guns, has no more ammo, it's done. So now the market is being driven by the long side, long buying, long selling. So I get a kick out of people saying it's a short squeeze, shorts are causing the stock price to go down. And I look and I go, no, positions haven't moved, or I don't see the rates moving. So I'm like, well, if you're telling me that the shorts are exiting the trade or the shorts are getting into the trade, shouldn't rates be going up or rates be going down? They're not. So it's not the short side that's doing this, it's the long side. So as a long investor, I want to know, are other longs losing their conviction in the name and getting out of a name, and I'm left holding the bag? So it's really important for the long side to say, hey, who is moving the market? Is it the shorts? Because that's a narrative that you get a lot on the street, but it's not the true narrative. It's really, hey, this is long selling, not short selling, because the rate's not moving up.
Wow, so the rate does give you a lot of good information about really the demand for shorting.
Exactly. It tells you the idea of whether who's moving the market. And you know what? Maybe you guys have me on again. We just created a squeeze and crowded indicator, which is basically going to be able to tell people what stocks are coming up that look like they're squeezable and what stocks are truly crowded. Because we get a lot of questions.
I like it.
What's a crowded store?
I like that because we're in the hot stocks, right? You know, like we cover all the big sectors. Now there are places we don't play, the EV, etc. But it's very interesting all that. So Ihor, we got to have you back on. Thank you for taking the time out of your busy day. Really appreciate it.
Yeah, we appreciate it, Ihor.
Take care.
All right, everyone. You got the value. We'll check you next time. This is Grizzle Live.